trading tsunami, wild week, man. Let's move ahead to the next slide. We know the Fed raised rates, but the interesting thing was what he said, right? Like I'm sure like you guys, in this case, I was actually watching. I usually never watch, but I happened to watch the thing, right? Because I really just wanted, it was sort of like he was just like, nah, 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 nah. I was watching markets on every word that he was saying, and you could just see that the markets were just rising. He goes, this disinflation process has begun, but he also said he doesn't see rates cutting this year. And that's really interesting because the markets completely ignored what he said, and they're looking like rates are going to cut. BOE and ECB, they lift 50 basis points, and both of them had said different things. You know, like one's like, well, yeah, we're good, we're going to stay right here, and the other's like, we're going to keep going. You know, we're worried about it. Google, Amazon, Apple, flop, big time flops. Meta, they rocked. I don't know. Did you guys play? I'm sure you guys played these.
I didn't play Meta. Well, I had a downside butterfly that I made a couple pennies on in Meta, but the rest of them I have flat to long delta, so it should be interesting in the morning to see where we open here. But a couple of them should work out. I should make some money in Google and Amazon, and Apple might be a little bit of a loser, but we'll see.
Yeah, I've got a trade on Amazon. That should be good. And I'm just so happy that I missed Meta and I was traveling.
The Meta news is
I love shorting
numbers.
I love shorting the Zuck. It's like one of my favorite things.
Oh.
And I just would have got my face ripped off because I would have done a downside diagonal or something like that.
And it would have gone to zero.
Yeah. But yeah, crazy implied volatility in the 0 day or the 1 day yesterday for all those stocks. So we did that.
Yeah, I mean, that's been a play for sure, like in recent times. So, I mean, everything was going great, honestly, like throughout the week, right? We had the Fed, markets were moving, tax going, all these names. Then these guys come out last night, terrible earnings, and then jobs report, man. I mean, who knew 500,000 people were added to jobs and unemployment rates at a 54-year low. So it's almost like we've had two different weeks in the last couple of days here. It's kind of wild. Seriously.
Yeah, it really is.
Yeah.
So this last data point, I don't even know if they really matter much anymore because these two are probably about to change given the day that we're having right now with VIX and VVIX.
Yeah, VVIX is something that I haven't looked at in a little while here. It's a way to look at the volatility of volatility and gives you an idea of like, you know, the pricing of volatility, if it's pricing in big moves, big changes in volatility. It's really not. It's been relatively contained here at the lows. Volatility below the 20 handle has been a short-lived phenomenon over the last 3 years. You know, we've had these like couple day clusters of volatility below 20, but anytime it gets below 20, it kind of perks my ears up a little bit and puts me a little bit on edge.
Did you notice yesterday, like when we were just literally drifting higher. We even get to 4,200, and all of a sudden the VIX started perking up. We were sitting at the table. Me and Tom were talking about it as it was happening. You know, he was like, "Are they pumping vol back in? Because it just seems like it." And I was like, "Yeah, totally." VIX started popping, and we saw that dreaded, market up, VIX up thing. And as soon as that happened, markets started turning. It's almost as if, obviously, that's something that usually sort of bumps its head against the ceiling, and we start to come back down. But it was almost as if markets started getting worried about these earnings coming up and the jobs report. It was kind of interesting.
Yeah.
Yeah, there's a huge front-loaded distribution in SPX. The expected move for today at the end of the close yesterday was about 50 points, which makes up 50% of the expected move all the way through February 13th. So big expectations for today's market movement, and you're seeing that right now. 9 minutes before the open, we've already exceeded the expected move for the day to the downside.
No doubt. It's wild. Let's move ahead to the next slide. Got some charts for you guys. So this type of week, this type of month, man, that we've seen, it's been crazy. One of the best Januaries we've seen in a while. This is a look at put skew and select ETFs. Top three where put skew is fairly high. Probably not a surprise. Retail, home builders, consumer discretionary. They're the ones that have really kind of been screaming off the lows here. You see the rest of them compared to tech. You see HYG, they're high yield. You see the S&P 500. And when you look at their January performance for these three high ones, it makes sense. I mean, there's XRT, there's XHB, and there's XLY. So big put skew in the names that have been screaming off the lows.
Yeah.
And
Right.
higher rates. It's hard to buy homes. That's part of the process.
Yeah, and we've been hitting recent highs, which I think just helps add to the put skew and the fear of a retracement down. So, doesn't surprise us all that much.
Yep. Let's move ahead to the next slide. Basically, since the beginning of the year, you've seen big changes, and it's completely opposite of what we saw last year. So, comm services was down big last year. Consumer discretionary, we just talked about. Tech was down obviously last year. They've flipped so far this year. They're going up, right? Same thing with energy, industrials, consumer staples, healthcare, and utilities. Those have been sort of kind of flat to down. The only ones that are doing the same as last year so far, materials and financials. Kind of weird, but most of these pretty much it's a mirror image of what we saw last year so far.
Yeah, it's interesting. Oil's been, it's back to kind of a normal-ish spot here in the mid-70s, still higher than what we've been used to over the last, couple of years. But yeah, it's a complete flip.
Yeah, man, complete flip. Yeah,
and gold and silver. I mean, both the metals have been super strong. It's, it's a funky one.
It's weird. Let's move ahead. Earnings have been just kind of blah, man. The average, earnings surprise compared to estimates, it's only been maybe 2%. And so I think we kind of know peak earnings pretty much happened that first quarter of 2021 and 2022, but earnings have definitely really disappointed for the most part. And it's been really kind of, not surprising, but this is just your visual proof to know that earnings really have been real lackluster.
Yeah, and I think in the beginning of 2021, 2022, we saw a lot more implied volatility. Like we weren't doing diagonal and calendar spreads in 2021.
Right.
I don't believe.
Yeah.
And it's because implied volatility was much higher than it was now, and you can kind of see the distribution of implied volatility is kind of representative of this lackluster earnings expectation.
Yep. So we had a slide. Tom is gonna love this one.
Well, he's not here, so he doesn't have to chime in. We don't have to have his opinion.
So buying this is a chart of what kind of premium you get for buying calls. So buying calls ahead of earnings has yielded 29% premium quarter to date. This obviously doesn't include the day in the last couple of days. This is from going up until last week.
Okay.
So this is compared to a full universe of stocks with liquid options. If you buy calls 5 days before earnings and sell 1 day after, it's been like a 29% premium for you. So basically a lot of names, even though earnings haven't been great, somehow names have drifted up into earnings. Yeah, this doesn't include this week, but a lot of names have drifted up into earnings, it would seem. And so this has been somewhat of a strategy that has sort of outkicked his coverage more recently compared to the long-term average of like 12%. So something kind of interesting, I thought.
You've also had a strong market to start the year. I mean, we've had a 10-ish% rally in the market as a whole. The E-mini S&P 500 futures opening somewhere around the 3,800 mark to start the year. We've drifted higher to we're sitting at 41.3 right now. 4,130 right now.
I was about to say, don't do it. It's going to change.
I know. So we've had a strong market, so that helps you. If you're buying 5 days before, we've had 1% every day basically to the upside.
But yeah, we've seen this too. We've seen the markets just rip higher before earnings, and then maybe earnings just are flat, or maybe there's a little reversal. But if you're buying, like you said, if you buy them 5 days before the earnings announcement, you probably got a big chunk of that profitability even before the announcement was made. And there's not much volatility crush, especially if you're going out to these monthlies. There's just not much of a volatility crush out there, which helps you.
Absolutely. Let's move to the final slide here. Wrapping up some of the stuff to the week. NASDAQ probably still is, off this best start since 1975. Thursday was the largest options volume session in a day of all time. 68 million contracts, 40 million were calls. Pretty sure there was a lot of zero DTEs in there as well.
Yep.
There was a talk about this. He's starting to wonder if there's a China trade war possibly coming again. U.S. was halting new licenses for Chinese for technology exports to China. So keep an eye on some China names. There's also been a lot of strange stuff with China names coming out of that Lunar New Year, which is kind of interesting. Speaking of China names, Baidu, China's Google, is supposed to be launching a chat GPT-like bot. You know, I ain't going to use OpenAI.
No.
I saw an article on that guy the other day. Dude, he's got it. You guys, it's an interesting article. He's got an interesting life, really.
Send that my way. I'd love to read it.
Yeah, I'll send it your way. I could see how this would be a guy who would turn to AI.
Okay.
That's all I'm gonna say. Intel had terrible earnings, man. You got to wonder if it was a bad sign for stocks. I've seen a couple of other names that sort of tanked a little bit on earnings. NXPI was one of them, but it did kind of bounce back again to the point of just kind of following the market, drifting higher. And then research. January 30th was a skinny by Dr. Jim, a cheap way to hedge. He was actually talking about zero DTEs. Not that we're promoting trading a ton of zero DTEs around here, because personally they're not always just fall. It's sort of like it's kind of put call parity. It's either in the money or out most times. But be careful when you trade those.
Good stuff out of you, Jamal. Thank you for joining us on this beautiful Friday. We're going to take a quick little 90-second break. We'll come back for the opening bell, which is coming shortly. You're listening to Tasty Live.